Hey, good morning, traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. I'm your host, Bennett Tyndall. Hope you guys are doing well this morning. Happy March to you all, Wednesday, March 2nd. I can't believe we are approaching the end of the first quarter. A lot of market volatility this year with, of course, the uncertainties regarding inflation. Now we have the geopolitical uncertainties. Last Wednesday evening into Thursday, we saw the escalation of the Russia-Ukraine situation. The overnight move Wednesday night into Thursday was really rather interesting. We actually had an overnight move lower in the futures market. At the same time, we saw crude and gold catch a bid. As we approached the cash session last Wednesday, however, we saw the bid for gold and crude fade. We then saw a sizable recovery effort in the cash session for the indexes. We ultimately broke south of the levels we had talked about last Wednesday, and we did find support at the 38.2% retracement in the S&P 500. There's still the chance we go lower, obviously, with the situation overseas. We'll get to the charts in just a moment. Before we get to the charts, let's go ahead and bring in the trading analysis team. And as you can see, bottom left-hand corner of your screen this morning, we've seen another huge move in crude oil. And in fact, before we get to the team, let's quickly touch base. We are entering March, and of course, we have the March Fed meeting, a very key event many investors are anticipating. And taking a look this morning, we did have ADP non-farm payroll coming in 475,000 versus the forecast of 378. Non-farm payroll on Friday. We've got some Fed speak this afternoon. Looking at CME Group's countdown to the Fed, we've now seen the expectation of a half a point move from the Fed in March essentially fade. We had the January CPI data. We had talk out of James Bullard regarding potentially that half a point move. And as soon as we got January CPI data, we saw the markets shift in favor of the half a point move. We're now looking at 92.5% chance of a quarter point move and only a 7.5% chance that the Fed does move half a point. And in light of the Russia-Ukraine situation, there's actually been talks of potentially the Fed doing nothing. So the market uncertainty, the market volatility continues. We'll take a look at the wave structure in just a moment. Before we do that, let's go ahead and bring in the trading analysis team. We are one short again this morning. We do apologize, but what's up, Terry? Good morning, sir. How are you today?
Well, you got half of the rest of your team here, so
yeah, that's right.
Hello, everybody.
We're good. We got this on lockdown. How are you today, Terry? You doing well?
Oh yeah. Everything's nice, and things are starting to look like spring down here in southeast Texas again. So already starting to see azaleas bloom, believe it or not, at Bennett. So
nice.
All this cold weather we've had, we've got flowers already starting to pop up.
They're resilient, I tell you, like the markets we've been in.
Yeah, this means I got to get out and help the wife in the garden more. So
it's always good times, though. It's peaceful working out in the yard. I got to admit.
I guess that's a good thing to have. I mean, we feel bad for the folks in the Ukraine. This is a situation nobody should ever have to endure. And we joke about how good the life we have over here. Well, we are very blessed with the freedoms that we have, and we hate to see when someone else is losing their freedoms.
Yep, very well said. Very well said. Difficult situation overseas. We'll continue to stay on top of it here in the markets and take it one wave at a time.
Hey, got some echo coming back in, Bennett.
Yeah, we're gonna call an audible here. Check this out. Let me do this. I got a message. I'm gonna pan you to the left. I'm gonna take my shot. It's probably the echo on your end. Maybe my audio's hotter than normal. What's up, Alex?
Hey guys,
sorry I'm late.
No worries,
Maybe
man.
Let's go to meeting.
What's up, guys?
Not much. How are you today, sir?
Alex,
I'm fine.
You need to mute yourself and go to meeting.
Oh, okay. So that's the problem.
I got it. Okay.
Sorry for the small delay,
That's
guys.
what it was.
I actually, I have to admit, I fell asleep on a chair because I wake up in a 5 o'clock this morning. My son had the early training around 7, so I had to be very early. So I just wanted to have a kind of a 5-minute nap, and then So I apologize, guys.
Hey, no worries, brother. I've been there. You go to, take a 15-minute nap. Next thing you know, you wake up, spend an hour. So
yeah. I was just aware. Terry's calling me on a Discord, and I thought, oh my God.
Oh, I see. I did wake him up. Okay, good.
Nice. All right.
Sorry, guys.
No, you're good. You're good. So, hey, let's hit it. I'm going to take you guys into the Motive Wave platform. We're going to take a look at the price action in the indexes. We last week looked a bit at crude. I'm going to go ahead and leave that for Alex, but we do see it's kind of a wide upside zone. We were expecting the 100 handle. As you can see this morning, we're north of 110. Got actually support up to like 120 in this wave structure before a corrective retracement is possible. Not that it couldn't come sooner, but we looked at, I think the biggest technical development for crude oil that we looked at in the past couple of months was the break above that decade-long downtrend resistance line, and then of course the 786 retracement. We know those to be two very key technical developments. Typically a break above and support from the 786 will take you up to a 1272, which would be above its $150 area, 2008 I believe it was highs. So sky could be the limit there. We'll get to the charts. We'll let Alex take a look at that. Boys, I'll be back on the other side. I'm going to take them through the indexes, and then we'll carry on. Sound good?
All right, very good.
All right, get you guys in just a couple minutes. All right. Good morning once again. We do appreciate you all taking time out of your day to join us. Let's go ahead and hit it. Hard right edge of the Motive Wave platform. We're going to take a look at price action in the S&P 500. When we met last week, we made note of the fact that price action from the January 24th low was a bit tricky in that first, we saw the Dow Jones Industrial actually deliver a 5-wave print. Second, we saw the XLK technology sector, which is the most dominant S&P sector by weighting. We saw the XLK technically rally in what could be counted as 5 waves. But then we had charts such as the Nasdaq 100, which had printed more of a 3-wave move back to the upside from the January 24th low. So we had to acknowledge last week one of two possibilities. Possibility number one was that the January 24th low did mark the end of the overall orange primary degree wave 4 correction, and that the move up into the 9th of February was wave 1. In the case of the S&P, given the February 9th high did not exceed the February 2nd high, as we did in the Dow Jones and the XLK, we had to consider the possibility that we had a truncated 5th wave, which means if you follow my mouse from the 24th, up in 1, down in 2, up in 3, down in 4, up in 5, ABC, back down into support. Based on the way markets were continuing to probe the downside support last week, we were certainly aware of a potential break below the January 24th support. When we met on Wednesday, we saw that continuation lower into the cash session. That was the 23rd of February. Wednesday night into Thursday, we had the escalation overseas, and as you can see with this particular bar, price action actually gapped down the next day. So if I bring in cursor data here, you can see the close from the 23rd was, in this candle, 42.2610. We opened up the next 1-hour candle at 41.55. So we broke through the 42.22 trigger point. We knew a break under that trigger point could take us to the 38% retracement at 41.37. And then alternatively, we knew that it could take us even as far south as an equality measurement to this initial decline. So the initial decline from January 4th through the 24th, projected from the February 9th retracement. That was down near 4,000. Interestingly enough, at 40.20, there's actually a little micro gap in the S&P chart from April of last year. But what ended up happening is markets defended the downside gap on Thursday, and price action, if I take you down from a 1-hour chart to a 15-minute chart, and we look at the entirety of the 24th session, we kind of opened up or finished into this range here. Not only did we have a sizable gap to the downside that day, it was a gap to the tune of 1.5% down to the low 2.5%. This is the S&P. It was even more significant in the Nasdaq. But then markets flipped the script held the 38% retracement, and we rallied and essentially erased that decline. So looking at price action from the low of the 24th, we do have what can be counted as a 5-wave trend. Interestingly enough, the 5-wave move, and allow me to erase this, the 5-wave move also met resistance at about a 61.8% retracement of our February 9th through February 24th, in this case, decline. Now that we've printed 5 waves into the 618, we have one of 2 key possibilities, and we're going to look at another possibility in just a second. Possibility number 1 is that that marks the end of the orange primary degree wave 4 correction. And I think given today's market uncertainties that the multiple possibilities are a great illustration of the fact that Elliott Wave is essentially a living, breathing being of sort, in that it's reflective of the underlying sentiment of the market. And in times such as the one we find ourselves in now, that sentiment is subject to change, which is why we feel it's important to have multiple wave counts that are valid, to have a plan in the event plan A does not go your way. Otherwise, you're left scrambling for context. So if that technically marks the end of the correction, and we are going to rally for that final 5-wave move prior to the larger correction being a possibility, then we've got a downside zone of support that we now need to hold here in wave 2. Downside support as far as the 786 retracement at 4171. Typically we would dive into the wave 2 itself and look at the Fibonacci relationships of the corrective structure. So, C compared to B, C compared to A, etc. I want to focus on the support zone in the wave 2, meaning I want to focus on the retracement zone. This gives us a fairly broad zone of downside support that markets can meet and then start a rally back to the upside. If we see further escalation of the situation between Russia and Ukraine, perhaps it carries on into other areas, and there's been talk in the media regarding that, then what are the possibilities that we break lower? Well, there's still technically a possibility that this is just a standard ABC correction and that we actually had a truncated 5th wave into the 28th of January. That means the initial actionary decline ended on the 28th and not the 24th. In this view, we would have to suggest wave C to be an expanding diagonal because we have overlap here between our corrective structures. I don't favor this count as much as I do the count which says the corrective low is in. Now, what are the chances that my analysis of the S&P is wrong, in that 5 up, 3 down, and 5 up, instead of it being a essentially 3-wave move at that point, is there the possibility that that completed the higher degree wave 5? In order to get there, we've kind of got to stretch the possibilities, which is why we looked at last week the alternate view of the ending diagonal. I talked about how we can kind of work to either dismiss or confirm this view. Getting off the daily down to the 15-minute chart, actually we'll go to the 1-hour chart. In our preferred view, the S&P 500 completed a correction, a complex correction, 3 down, 3 up, and 3 down into the 24th of February, and we're now rallying impulsively higher. In the alternate view that we discussed last week, which would suggest that this 5-3-5 move is actually wave 1 of a wave 5 ending diagonal, there's a possibility that we've actually completed an initial expanding variety diagonal. Now, here's one reason I don't support this view. Wave 3 in this instance is clearly larger than 1. 4 is clearly a more significant retracement than 2. But 5 failed to reach equality to wave 3. But given the complexities of the market off of the November 22nd high, I'd be a fool not to at least consider this possibility, because there are instances throughout financial history where you can go back and you can find certain structures that don't quite meet the rules and guidelines of Elliott, but ultimately proved to be valid, in that the implications of that pattern rang true moving forward. So let's imagine, if we would, that from our preferred view that says, hey, this was a complex WXY, 38% retracement held, we're up in 5, we got to go back in 3. Then we're going to see the final 5-wave move up to maybe 5,400, and then that larger 2022 correction. If this count is not the view, then what's going to end up happening here is we're going to hold support in our estimation. And on the break north of support, we're going to see a move up to maybe 45.5, 45.30. That would represent an equality retracement of sort, or an equality projection. What I want you to take away from this is over here in our count that we presented last week, which said, hey, look, in the event we go lower, we're not going to jump on the bear market trend and say that this is a completed cycle degree move from the credit crisis lows, but instead we're going to view this as an ending expanding variety diagonal, which would still, or excuse me, contracting variety diagonal, which would still give us the possibility of meeting those upside extreme targets. If this is the count, and we really do have a 5-wave expanding leading diagonal in a wave 1 position, or maybe a wave A position, then instead of this being wave 1 and this being a corrective retracement in 2, this is some sort of an A, B, C move, and that's where we derive the equality resistance from, near 45.30. And you'll also notice that's about a 61.8% retracement of the January 4th through February 24th decline. So we're remaining optimistic here at Trading Analysis. We're going to focus on this zone. If we see the divergence that we need, the positive divergence into it, and then the 5-wave rally out of it start to commence, we're going to look to at least trade a move up to equality. It's the move back into 4,500 to 45 and a half area that we need to watch out for, because this is a very dynamic situation with multiple possibilities and risks ahead. So that's the S&P. Looking to the Nasdaq 100, the Nasdaq 100 shares a very similar wave count in that we can view this as a completed complex structure, meaning 3 down, 3 up, and 3 down to complete orange wave 4. We have the same 5-wave move up. We're working the same 3-wave retracement. Watch downside support between 13,319 and as high as 13,667. Technically, this wave 2 could be complete, but I do think we probe further to the downside. So that's the Nasdaq. Looking to the Russell 2000, the Russell 2000 here is one of a handful of charts which do challenge the view that this is some sort of a wave 4 and we get wave 5. However, it's not an invalid view. And in fact, if this is the case and we did complete our wave 4, we held more or less the 38.2% retracement of the wave 3 rally. And we also have demonstrated not only alternation to wave 2, but now equality in time. The guideline of equality is in duration or magnitude. In this case, it would be the duration of wave 4 compared to wave 2. Off the daily, down to the 195, we can see a similar 5-wave move up, working a 3-wave retracement. If you fail support and you start to probe south towards 1894, this could be one chart that is ahead of the ball game, suggesting a larger retracement of the post-COVID low rally. Okay? So that's it from me. I know a little bit more difficult and in-depth than we typically present. Generally, we've got high conviction in the wave structure possibilities. It is typically pretty clear based on how a count adheres to the rules and guidelines, which of the two is most favorable. In this instance, we've really got to take it one wave at a time, one wave at a time. We knew the break of the 24th could open up 4,100 to 4,000. We got the 38% retracement. We now have a mode of structure up. This is either 1 or A. We're in 2 or B. Watch the equality rally up towards 45. And it's going to depend on where this wave 2 is anchored. So watch the equality rally once it begins to get underway. So hey, that's it for me this morning. We're going to go ahead and jump back over to the trading analysis team. What do you guys think? You think orange wave 4 is over, or do you think we've got more volatility ahead?
Well, I definitely see more volatility ahead, and I think we're in a larger counter trend correction move, right? The longer term uptrend remains up. Okay, we're still in a longer dated uptrend, but these counter trend corrective moves are very difficult to when you have so much overlap, that's what you get. That's why we have so many wave threes or ABCs and things like that in corrective moves versus in impulsive moves. When we have a nice trend, it's much easier to see. In these corrective waves, the reversals happen very quick. You could be in one day and be stopped out the next if you try to jump in too early. So I laud your confidence in the wave counts, Bennett, that are showing us the alternatives, the possibilities, because we all have to take it into our own individual risk plans as to whether we want to try to jump in now because we have fear of missing out and take a risk. But so each of you have to answer that question on your own. At some point, some people like to jump in early. They will risk catching the falling knife, the proverbial falling knife. But if you're more conservative, then you need to wait and just continue to be patient until we actually get to the confirmation signals that we teach you all the time on what we're looking for when we see the trend resume. Okay, so I won't say the trend reversal. I'll say the correction reversal resumes back in a larger degree uptrend. So that's just a little bit of experience talk in there and cautionary talks. Everybody wants to be in it, but I mean, you got to look at this geopolitical, such a large thing like the Russian invasion right now, and then the smaller topic is the Fed at the moment, right? So somebody was asking me, does the Fed want to take over is the Fed going to make the front page news over the top of the Russian invasion Ukraine with the speak that they're going to happen today? I don't believe so. Is the Fed going to stay their course? Well, I don't know. We'll listen today and hear what they have to say today and tomorrow. And so you got a couple of dynamics just kind of holding you back. And it's just one thing. The market hates uncertainty. But after the market gets that uncertainty resolved, then there's more push to the upside. Sorry, I'm taking.
No, you're good.
This is totally off script, but it's just in response to what we're seeing in the markets here.
Yep, totally agree with that. Very well said, Terry. And just had a comment regarding the S&P could be flat, and I was hoping we didn't have to cover this view, but it's entirely possible. A very interesting point, and I just kind of switched the screen here. The gentleman who mentioned it, the decline from the 9th, 10th of February into the 24th low was a 1272 external retracement of the January 24th through February 9th rally, which means this could be A, up in A, down in B. We get 5 waves of C into this B wave resistance and then go. And you know what this is similar to? Let me take you over here to the 1 day. It's a lot like what we got back off of the September 2018 high, where we had this initial decline. Although in the B wave we didn't break to a new low, but it could still be kind of a similar expanded 3-wave structure. And I tell you what, if that's the case, my job just got even more difficult. But I love it. I love every minute of it. I love every minute of it. All right, Mr. Terry Long, sir, you ready to jump in?
Yes,
Take the screen? All right, let's hit it. We'll be back on the other side, and then we will carry into some macro discussions. Catch you guys in just a couple minutes.
Hello, traders. I'm Terry Long at tradinganalysis.com with your weekly sector focus. And with the long-anticipated Russian invasion of Ukraine beginning last week, we saw volatility for sure in the marketplace. The volatility spiked, and tensions did ease somewhat near the end of the week as talks were on the table, and the markets did make this swift reversal move back to the upside. We started out down and then a big move back up. Anybody with half a brain looking at the size of this weekly move right here, that's the definition of volatility, right? The S&P reversal netted for the week, the S&P a gain of 0.82% on the week. Now, the NDX moved in a similar fashion, rising with a net 1.28 after this huge move, down on Thursday. Actually, as a gap open down on Thursday and then a rally back. And the NDX rallied to close much higher than the S&P. Now, looking over here at the sector performance, leading the reversal was the healthcare sector, up 2.7%, followed by real estate, up nearly the same, and then the utility sector, about 2%. Communications and technology saw 1.66 and 1.25% gains, while the consumer discretionary sector continued to push to the downside. And last week, the energy sector, for the first time in a while, was actually in the middle of the pack rather than being either the top winner or the bottom loser like it has been for several weeks recently. Now, from January 4th, I'm going to take you back here, from the January 4th highs through February 24th lows, the S&P had seen a maximum drawdown range of just 8.5%. Okay, so I'm sorry, 13%. I'm sorry, I'm looking at the wrong number here. A maximum drawdown range of about 13%, while the NDX had seen a maximum range drawdown of about 20%. Now, Thursday and Friday's combined push back to the upside reduced the S&P's drawdown to 8.5%. And back down to about 14% for the NDX. So let's fast forward to this week, and I want to share with you what's happening this week. So Monday and Tuesday's action here. Monday saw the market somewhat mixed, and actually the energy sector is once again, look here, out in the lead as the crude prices continue to rise past the psychological $100 a barrel level. Indeed, I was looking at it pre-market this morning at 111 for West Texas Intermediate, and then Brent crudes of $3 or $4 higher than that. Monday saw the S&P actually close lower by about 0.25%, while the Nasdaq, or the NDX 100 closed higher about 0.34. On Tuesday, though, the markets did push decidedly lower, with the exception of the energy sector, which rose another 1%. S&P declined 1.55% on Tuesday, and the NDX closed down 1.6. So if we take a look and just draw these down now to where we're at, you can see we're currently at a 10% drawdown below January highs in the S&P. And let's see if I can grab that little marker and pull that down. That says we're down about 15.1% on the NDX. Now, choppy seas likely remain in the forecast with the ongoing Russia-Ukraine saga and the Fed speeches that we have today and tomorrow. Now, over here in our sector leader scoreboard, the energy sector is the farthest outlier, now posting a 115 relative strength ratio compared to the benchmark S&P. And the staples sector remains in second place, but it did lose a little bit of momentum, falling off with a 0.16% decline last week in the staples sector. It's beginning to show a momentum decline. Now, also remaining here in the leading quadrant is the financials, the utilities, the materials, the healthcare sectors. And momentum does appear to be stalling out, though, in the financial, as our vector has turned from green to yellow just with this current week's move. So financial sectors, some of them have some serious Russian exposure, and the sanctions are going to be a negative for many of the large banks, probably more so in Europe than in the U.S., but still there are many U.S. banks with similar global positions that are going to be affected. And so there's putting some pressure on that upward momentum here in the financial sector. Now, the real estate sector has exited the leading quadrant with a higher velocity move last week, but the velocity is slowed down, I can tell, by the tail. That length of the tail this week is much slower, or much shorter than last week. So velocity to the downside has slowed a bit, though. Interestingly, the 2.64% gain that it made last week The trend still is yellow here. Now the industrial sector, actually, the industrial sector has moved last week with a gain of 0.8%. Its blue improving weekly trend vector shifted back and forth overnight, I think from blue to red back to green, as the industrial sector I'm seeing now just now penetrating into the leading quadrant. It had been very slowly approaching this. It's kind of the last group of the value plays pushing up here into the leading quadrant. Now down here, the technology sector has finally penetrated into the lagging quadrant with a continued southwesterly heading. The communications sector had actually started to show a little bit of rising momentum. I talked to you about this last week. This would have been your picture last week, but we didn't get the confirmation. So I don't consider the hooks are confirmed and the bottom is in necessarily for consumer discretionary when I see a continuation move further to the west, right? So the momentum is stable. If it moves horizontally, the momentum is constant, right? So there was no gain or loss of momentum like we had been seeing a little bit of gaining momentum in the 2 prior weeks. This week, it's basically stalled out. Now, finally, the communication sector, it continues to see a bit of momentum rise. It's now crossed into the improving quadrant. And stocks in this sector definitely deserve continuing monitoring, as several are in the group are improving rapidly, and that is pulling the XLC out of its corrective cycle. Now, if we have a little bit more time, I want to share some ideas I have in the gold miners subgroup of the materials sector. Gold, I think this morning, pushing up, looking at it right now, it's 1928. It pushed through our line in the sand, which invalidated our triangle that we had saying the triangle was ongoing. Therefore, we've put the triangle in its place, either anchoring the E wave here or anchoring the E wave here, either one of these places, and I'll let either Bennett or Alex go through their gold wave counts for you. But one of these two places, more than likely, this corrective move is over, right? So we've got to push to the upside. And now what we really need to be looking for is the next smaller degree corrective move that pulls us back and gives us an opportunity to get in. If you look inside the weekly RRG, it looks like the gold rush of 2022 is here, right? So take you back to the 1st of January. We had a few of these gold leaders a few of these gold miner stocks push into the leading quadrant. So they were the early leaders, Pretium Resources out here in front. But everybody, the rest of the pack was really holding on. Now that we get a true turn in gold, that's why I said, I think, now you can see the impulsive move. You can see the pack moving aggressively to the northeast. And while you have already existing leadership positioned over here, you've got a really nice set of secondary leaders here coming up behind. I might take you into one of these. Let's take a look at a chart of New Gold. New Gold last week declined nearly 15%. We're seeing right now, you can see this week, we've got Harmony Gold up 21%, Anglo Gold up 11%, several of these miners, but we've seen this before with these large pushes up one week and then a large drawdown the next week. And then, so I want to get to New Gold here. New Gold was one of these ones that was down sharply 15% last week. But what I saw in New Gold, let me go ahead and make that full screen, because I want you to see this downtrend, right? This simple downtrend that takes into account the June high through the November high. We penetrated it once to the upside here in early January, broke down below it, and recaptured that support. This resistance line, in my opinion, has now become a new support line, okay? So from where I think we launch a continuation move to the upside. So if you're aggressive and you want to just get something on the table, here's an opportunity that I had laid out for our clients on Sunday. And unfortunately, we've already had 2 more days before we get to you guys here on the Wednesday live stream, that we've already seen a move higher here, because I initially had the entry level here. Now, how I developed this was simply take a fib retracement from this January 27th low through this February 17th high, and then now we're looking back here. This is 618 and the 786 retracement levels. You can pin your stop loss just below the 786 when we're looking for the end of this corrective move. It's possible this corrective move is not over and we get more. This is down in A, excuse me, up in B, and then back down in C again. So that's why it's important to have your stops low. And for the upside, my target is actually setting that we go back and test the June highs one more time. So it's just as simple as that. And if you use this little tool that we have here in Optima, it goes ahead and gives me all the metrics. I've got about from where I had my entry point, I've got about a 10% drawdown to the bottom with a 30% upside. So I've got a 3-to-1 reward risk ratio. Now, if you're looking at doing that entry today, the problem with that is we're priced up here right now. Let me just move that on up and show you the difference. So now, if I move it to where today's price is, you've got about a 13 or maybe 14%, 13.5% down. So, and then your upside gets pinched. So if you do the math and divide this into that, you see that you're now maybe about a 2-to-1 on the reward risk ratio, right? So if you can be patient and you want to put your entry level a little bit lower, right? Possibly you get an entry on an even smaller degree time frame right here. You might catch this bid. The key thing is keep your risk low. You know, establish appropriate reward risk levels for your trades, guys, and I think you'll be even more successful. So, and but a word of caution. One more word of caution. Some of these stocks have already moved much higher since I first wrote this up on Sunday. So you can go through this list of stocks and apply the same methodology here. Just don't let fear of missing out cause you to disregard proper risk management protocols. All right, that's all I've got for you guys. Back to you, Bennett.
Excellent work as always, Terry. Much appreciated. I will be putting out a video on gold and the Elliott Wave possibilities tomorrow afternoon, so check that out right here on the Trading Analysis channel. Alex, sir, we're going to pass presenter mode your direction.
Sure.
And
working on
presenter. We're good. We're good.
All right.
Usually Terry's like 5 steps ahead of me in making him presenter. He's on top of it.
Well, yeah.
I was on top of it today. Great work, Terry. All right.
Teamwork.
That's right. That's right. Alex, sir, you ready to hit it?
Yeah. Let's go.
All right, let's jump into it. Here we go. We'll be back in just a few moments.
Hey guys, hello from the macro perspective from trading analysis. So a couple of our theses, unfortunately, in regards of the latest events that is happening, are playing out. The reason for them are pretty unfortunate, but the charts that we were looking is starting to show, especially on the interest rates, some of the reversals we have been expected for the last couple of weeks, even months. This wave count for the 10-year yields, we are tracking almost, I think, for a year. And we are seeing the mentioned divergence. I was not present last week, so 2 weeks ago we mentioned the possibility that the reversal on a 10-year yield is possible. Because we noticed that we reached our equality level for this ABC on the upside. We also noticed a large divergence on the RSI on weekly between the wave 3 and 5 on the wave count, and also on the RSI, which is a usually sign of a potential reversal, and we are trading now in rates at 1.79 on the US 10-year. So we are awaiting confirmation for a 5-wave move down. I doubt actually Fed will be so hawkish on rates with the latest developments. I expect these rates to fall further. Maybe today the congressional Powell actually talk with actually move these rates even lower, because I think the Fed will really back off of the really so hawkish and aggressive inflation run in 2022 due to latest events. So I do expect yields to come off and form a 5-wave move down, which will actually be searching some of the wave X in the 2022. So most likely yields are going to cool off and move lower in the latest events, and we are going to pursue the same wave counts which we have been looking for the almost last year in regards of the US 10-year yields. So on the European front, and I have been very vocal again, a very unfortunate events. I have been stressing also that one of the reasons for a potential move up can be a balancing of economy, but also some geopolitical risks. I don't know if anybody remember that, but this is the chart of the German 10-year Bund. The picture in the European economy, of course, dependent how this will all unfold, but most likely the relation between Europe and Russia and the world and Russia will definitely be on a different scale in the next at least 1 to 3, even to 5 years. So in that respect, now this chart of the 10-year Bund really paints the picture, because definitely since the Europe will be hit with the enormous prices of the gas, which is basically a main fuel for the German economy, which is one of the strongest in Europe. So you can expect that the European Central Bank will definitely ease off, and according to these charts, we are seeing already yields trading in the negative territory on the 10-year. This is the price chart inverted of the yields, but they are functioning vice versa. As you know, the wave count is just a little bit more clearer as regards of the Elliott Wave developments. So we clearly see that this support zone has held. We have seen a large spike on the upside in the price, which means yields are moving lower. People are seeking refuge. In the German Bund now we are trading at 170 almost. So I do still see a potential triangulation here for a year and a half. And when the European economy really starts to feel the consequences of this the relation with Russia, also high oil and gas prices, economy definitely will slow down, and we might even go to a recession. So the central bank has to be accommodative in this environment. So I do see a further development of a consolidation here, and then finally a relatively sizable move on the upside in negative territory of yields, which will definitely be deterrent to euro. And in that respect, I will still hold this as a triangle with the resolution higher, and the thesis is starting to work out, as I said, unfortunately, according to the latest events. But we are looking at charts, and currently charts are saying that the probability of this outcome is pretty higher than it was before. Switching to the dollar index, we have to take in consideration when you have such a type of events where we are still very hot in developments. We don't know what can occur in the future. My dollar wave count is relatively working fine up to current levels. We are seeing the wave 3 on the upside in this possible ending diagonal. My levels for the $99-100 will probably be reached. We are going to see a less hawkish Fed on the meeting, even more today. So I do expect a pullback, a final move down, move up, and completion of this C wave. And then we need to see really a 5-wave move down below these levels and a pullback and a continuation of dollar. My reserve count, usually I do have a couple of, usually I have 2 wave counts. But I have to introduce a possibility that if we get something more exuberant and things start to get even more worse, I hope not in the world scene in these events, we have to take in consideration that this is also might be a triangle in dollar. We see a small pullback and then dollar rips off around 110, 115 due to some other or the same but heated global crisis on the geopolitical level and financial level. So we have to have a liberty to on our wave counts to also include a couple of these scenarios. This will be my secondary one, but I will stay with this one yet, because I do not see in the situation that the global commodities definitely will go up, and I will see that potentially dollar might actually turn and go down in 2022, 23, and 24, and that will ease off a lot of pressure of the United States economy. It will also devaluate debt, which is a common theme, how you devaluate debt in deflationary scenario. So I will still stick with this thesis. My play as regards of a currency will definitely not be euro for the moment, from the reasons I have already told you. Also, that depends on a dollar, but my play in will be a commodity currencies, namely Aussie dollar and New Zealand dollar, which has a very bullish wave structure, which might unfold in the next year and a half. So I will definitely show you these charts in the next couple of streams. But for now, my view on dollar will stay within the limits that we have been displaying in the last even year. So I'm going to look for A, up in A, down in B, and up in C, and actually descending diagonal completing soon around 99 up to 100, and then I will seek for some reversals. If we look some of the other things, this is the Thomson Reuters Commodity Index here, CRB index. We definitely from the lows are seeing 5 waves up developments here. As you can see, I do expect a little bit of ease off here in a B wave, but definitely after that ease off, we are supposed to see a C wave on the upside, which means that after a small pause, commodities can be on the rampant in the next couple of months, even a year and a half on the upside. So be careful in that respect. As regards of oil, I will show you my chart that I have been following for some time now. This displays a potential flat, so this will be an ABC down for W. This will be a 3 waves up in A, 3 waves down in B, and 5 waves up in C, which are still not done. I do expect very soon, maybe 111, 120, I do see a pullback, which maybe indicates that in a week or two we might find some solution or some shortcoming piece or some negotiations for some time, but that due to some other reasons or the same one, I cannot tell in this moment. My final target will be between 125 or 30 to 139 even for the completion of this 5-wave sequence for the possible X wave, and this might even go in a span for this 5th wave around even to end or a 3rd quarter of 2023, coming in a 2024. So
Alex, what do you have for that 2008 high on that chart?
2008 high was 147.
Well, yeah, okay. So there's your overhead resistance to set an all-time high, non-inflation adjusted, right? So think about it. That 2008 high This is 2022. Good Lord, gosh, has it been that long, right?
Yeah.
So, you know, that's quite a few years plus. I could even see that same price level is actually going to be less of an impact than you know, than penetrating above it. You got to count the inflation that we've had for, you know, the last decade or so there, in the last 14 years, right? So,
Yeah.
guys, don't be surprised that you see oil push beyond the, you know, that $150 mark, right? So it
Yeah.
certainly
I
could
mean,
happen.
it can happen. I mean, I'm currently following the some of the forms and some of the ratios. We usually look for a flat. If we are in 335, actually, if you measure the lower level for a potential flat on the downside, we also got exactly 127 there with a small spike, but we reversed. So there is also a potential that this is a fifth wave on the upside, and you get here some big triangle in B down in C, and you get 5 waves up to even 200. So I don't know that. I'm going to track
So,
the first scenario, which is actually telling us that we are going to 139.35 or 40,
this
but
chart
below this.
this chart just fully demonstrates the strong issues of supply and demand. Let me tell you, back in 2008, the reason we had the crash was we had, with the rising price of crude, all the shale producers got more and more efficient at producing the energy. So we ended up in an oversupply situation because exceeding demand. It wasn't the fact that demand dropped off. There wasn't anything there that really caused the demand to drop off. It was simply we got into an oversupply situation. The COVID dip was because we lost the demand. Okay, the supply was there. The
Yeah,
supply was oversupplied, but interestingly, from 2008 down to 2020, you can still see, you know, the price of crude, you know, holding around that $70 a barrel mark, or you know, even maybe in a gentle decline. Alex actually has that trend line up there that kind of gives you that decline, and that natural decline is, you know, the supply. It's the free market working, right? So we get the rapid demand drop off with the COVID dip that drives the price, you know, extremely low. Demand is coming back. Apparently, the world is back on track, you know, for reopening, and the demand, believe it or not, the renewable energies cannot pace themselves fast enough in a year or two to replace the 100 million barrels a day of oil that the world consumes. Okay, I'm sorry, that's a, you know, that's a fantasy to think that renewable energies are immediately going to replace fossil fuels. We are making progress in that direction, and I certainly believe we need alternative energy ultimately to replace the fossil fuels. But it's not going to happen. It's not going to turn around on a dime, right? So right now the demand is rising more rapidly, and it's reaching back to the pre-COVID levels faster than the producers can come back in. But I'm going to tell you, at these price levels, you can guarantee those shale producers are going to ramp it right back up again. So again, we make this 5-way move back to the top. You know, at some point out there in the future, there's going to be another oversupply situation. It's just going to bring it back down into reality again. So that's my 2
yeah,
cents worth. I had 34 years in the oil field business, so I've seen a lot of booms and busts in my time. So it will come back again.
yeah. I mean, if you add to that demand and reopening of geopolitical risks, and there you have it. Some exaggeration in the fear and also prices spiking up. So that's
Yeah,
that's
Bennett,
a
I'm
kind of
sorry, I'm dragging us on here.
Oh,
We
you're
got to go.
good.
We're running out of time here. So
Okay, so let's look gold and silver shortly. So I'm still not convinced. I'd like to see more of a gold. I was actually surprised that gold went, in my opinion, in this type of crisis. This is not a very serious response from gold. In this type of events, gold as a kind of an old hedging instrument in a before when you face this event, gold will spike at least pretty sizably on the upside. A current response, I still don't see it as a five-way move from triangle. I do want to see a five-way move development to confirm a triangle. If we get some peace talks or something, you can be sure that the gold will move lower and it will ease off. So in that respect, I'm still going to have and juggle between the potential X wave and between this five-wave move which will actually confirm a triangle. So I'm not still convinced, especially we are still trading in the range. We have been nailing this triangle for almost 2 years or year and a half. And current breakout doesn't look so convincing to me, believe it or not. But as I already has been 20 years in markets and in different situations and in crisis, gold has been spiking in this type of events pretty sizably on the upside. I don't see that currently, and I'm really surprised that we are still trading below 2000 in this type of a crisis, where you have a global I mean, unsecure situation, even nuclear alerts and all sorts of other stuff, and gold still trades $120 above the last low. So this is really unconvincing for me. So be careful on that. I will be convinced if I see a five-way move up, which we still don't see from this potential E-wave triangle. So look out for a potential move if we have it above 2000 and then a pullback. I think will be telling for a further on the upside. So I'm still not convinced with this move. It's a very small one in regards of what we are experiencing. So I have no clue how gold can move in such a small increments of such a big type of events. Silver is the same. Silver also didn't portray a five-way move on the upside, which actually gives us the same situation. So I'm still not convinced for the silver move on the upside. We didn't break the main channel. We can count this as a one big flat into up in 3, 4, and 5. So as in gold, I would like to see a five-way move up above this channel line, trading around 28, 27, and then a pullback. And I will be more convinced for a silver going pretty much higher from this event. But as long as we are trading around these areas, resistance levels, and heightened RSI, I'm still not convinced that silver is done. Okay, so I'm going to keep my target for one more push downside, however crazy that will look. But technically, I still don't see 5 waves up, so I'm going to stick to the possibility we are going to see in some possible agreements or a little bit deterrent of the current situation, that the price of silver still might ease off, and then on inflationary account go on the upside, not on a geopolitical account, which is a completely different thing. So now we have a kind of a mix of it. So 5 waves up until I don't see, I'm not a believer that this is going to continue further on the upside. So let me show you cryptos. Tomorrow is Crypto Lab. If you want to see more on the cryptos, we do cover extensively macro environment. So I will still stay with the triangle. Triangle still works. I have one more wave count, which tells us we'll go to 25 or 20K. Until we hold this key 28,800 level, I will have to stay with my wave count. We have been pursuing triangle already from 2021 March, when actually, according to our view, the crypto winter started. And I think we are approaching and we are at the end of it. So for the next couple of months, I do expect crypto winter to finish and the further move on the upside. I'm going to stick with triangle. break of 28,800 will change this wave count for a 20K target, where you have a couple of very key levels, 38% retracement, and also a couple of other things. But for now, oddly enough, triangle is holding very well, so I will not change it until I see the reason for it. Okay, so if you want to hear more on cryptos, join me tomorrow on the same trading analysis YouTube channel with the Crypto Lab with Alex. So back to you, Bennett.
Very good, much appreciated as always, Alex. Markets are open. Members will see in about 5 minutes for the member webinar. We went a little bit longer today. Just to kind of reiterate our view here in the S&P 500, watch a retracement of the rally from the Thursday lows. If we do maintain a bid between the 786 to 50% retracement, then what you need to do is you need to take a Fibonacci measurement of this rally, project it from that retracement, look for the equality measurement. If you get up into the equality measurement and see some resistance, could be up against that alternative scenario. And then if we don't hold this fib zone I just showed you, we could be up against this diagonal. So hey, if you're interested in more of the content, please check it out, tradinganalysis.com. Again, tomorrow morning, Crypto Lab with Alex, 9 a.m. right here on the Trading Analysis YouTube channel. Appreciate you all sticking with us, members. We'll see you in about 5 minutes. Traders, investors,
give us a thumbs up.
Week. Absolutely. If you enjoyed the content, give it a thumbs up and subscribe with notifications. All right, boys. Appreciate it, and we'll see you guys in a few. Take care.